We're going to get the final numbers on the Christmas shopping season with the government's retail sales report. That's going to happen on Thursday. But before that, senior economics reporter, the professor, Steve Leisman, joins us now with an exclusive look at retail spending from actual credit data with our CNBC NRF Retail Monitor. Good morning to you, Steve.
Hey, good morning, Andrew. Yeah, holiday shoppers finished the year with a strong surge that brought retail spending in our CNBC NRF Retail Monitor up to nearly 5% combined year over year for both November and December. Okay, let's just look right now at December. Retail sales ex-auto and gas rising 1.74% over November. That is the strongest monthly gain in the 27 months of data we have for the monitor. Taking out restaurants as well showed an even stronger 2.2% gain. The data, powered by real credit card spending from Affinity Solutions, showed a 7.2% year-over-year gain for our headline index and 8.4% for the core. The late Thanksgiving meant December benefited from two key shopping days. The Sunday after Thanksgiving and Cyber Monday were both in December. They're usually in November. So we put the two together to see what the holiday season was like. The headline rising a robust 4.9%. The core up 5.1%. A good Christmas by any measure. The NRF saying in their commentary, quote, households are in decent financial shape as the economy remains on solid footing with low unemployment, growing incomes, and continued deceleration in inflation in goods. Looking at the 2 months combined by sector, you can see all kinds of good Christmas shopping stuff. Non-store retailers surging, 28%, clothing up 9.6%, general merchandise up 6.2%, health and personal care 4.5%, and gas stations, well, they maybe provided some funds for that spending. They were down 3.5%. Electronics and appliances, after a lackluster November, they had a strong rebound in December. What the monitor can't measure, though, is retailer profitability and whether you had last-minute Christmas rush resulting from end-of-season bargains, or, Andrew, if they were full-price sales. We're getting some mixed commentary so far from the retailers.
Steve, how correlated are these numbers, or how have these numbers been with the numbers we get from the government historically? I mean, is this like an ADP-style job situation, and then we see the jobs report from the BLS and we go, they don't seem to be the same? Sometimes, how do you think about that?
It's a good question, Andrew. Well, first of all, I will say this. We are just learning how these things are working together. We back-tested them. And on the back test, in other words, the data we ran before we made it public, we were more closely correlated with the revisions. The difference between this data and the government data is the government fills in some of its data initially through surveys, not actual sales. All of this data is actual sales. And the last time I looked, we were like within 0.3 or 0.4 above it. This time around, it's going to be a little different because the government does its seasonal adjustment a little different. They won't have this issue of not having those two big holiday shopping days inside of their number for November. So they're going to be a little different. That's why I take the two together, and then we'll see on Thursday how November and December come together. But our data correlates well with what you had Liz on last week from Bank of America. She showed strong sales. Our data is a little bit wider, we think, by income group, whereas Bank of America clients tend to be a little wealthier, perhaps. We're all across the spectrum. So we got to watch it, Andrew. You're asking a good question because we are in a new era of big private sector data. We're able to make it public. We're trying correctly to seasonally adjust it. So far, it's correlated reasonably well, but it's not spot on the dime.
Steve, that stock market continued to do the totally wrong thing based on that jobs report on Friday.
Yeah, look, there were people out there, Joe, who agreed with me and said, hey, it's a good number. It's good to have Americans employed, and others who were scared that I guess there's two components of that, Joe. The first is that you have this possibility of rising inflation that's going to have to cause the Fed to reverse. And the other is that the Fed could be making a mistake. And that's why, you know, if you read somebody like Krishna Guha this morning, what he's saying is the Fed's going to take a step back, Joe, and they're just going to watch how all of this plays out. And how it plays out as to whether or not it's inflation behind this bond yield surge or it's a concern about upward growth trajectory for the U.S. economy. You're going to have to watch it. We'll see. I continue to maintain, Joe, jobs are good.